Hello and welcome to another episode of Darwin Investors. Listen, we are in a recession, and I know there's a lot of people in the media saying that it's going to come in the second half of 2023 or the first quarter of 2024. But if you're sitting here watching this video and you're in the stock market, you know that personally, we have been in a recession for a very, very long time. And just this past week, you just had the manufacturing index come back from New York, the Empire State Manufacturing Index, lowest level since 2009. If you strip out the COVID low when we weren't even manufacturing anything at all. So it's the lowest level since 2009. We had 10,000 layoffs announced at Microsoft, 12,000 layoffs last week announced over at Google. I mean, and if you take out what the guy Kirby is saying over at Delta, and they're saying, "Oh, listen, we're not in a recession because there's a whole bunch of people at the airport." Okay, I'm saying that we in the stock market here today have been in a recession, and our portfolio should probably start looking like a recessionary portfolio. And what that means is we probably should be looking at companies that are like the Dividend Aristocrats. And the Dividend Aristocrats are those large, slow growing type of companies that have been building up their dividends, slowly increasing them year after year for the past 25 years. Now in this video, I'm not just going to show you some list of the Dividend Aristocrats or what have you, but because that's really easily searchable. What we're going to do is we're going to go open up a Dividend Aristocrat ETF, and we're going to go down that list of holdings, and we're going to find the ones that have had the highest return over the past year. And the reason I'm using that is because I don't see this year being any different than last year. I mean, it all just seems more of the same, at least to me it does. So I'm thinking that whatever worked last year is a good chance that it's going to kind of work this year as well, despite people saying that you want to buy last year's losers this year. I don't think that applies to 2023. I think we want to keep on piling into winners. And so in addition to looking at those ones that have the largest underlying return over the past year, we're also going to look at the ones and kind of compare them, see who's providing the best dividend. And lastly, we're going to see of these ones that are providing good dividends and have high returns, which ones are giving us the best options premium. So we're going to try and triple dip here. We're going to try and get the ones that have the largest gain, plus the largest dividend, plus the largest return on options. And if you don't know what I mean by getting a return on options, don't worry. I'll show you here near the end of the video. We'll go through my own personal portfolio that I did last week, at least my options portfolio, and we'll see how I generated extra returns on some of these stocks using options. So let's go ahead and get into this. All right, so we're looking here at the ProShares S&P 500 Dividend Aristocrats ETF, ticker symbol NOBL. It's currently selling for $91.35 a share. Over the past year, it's had a negative 2.81% return. Over the past 3 years, it's had a 24% return. It's rated 5 out of 5 by Morningstar. It's rated 4 out of 5 over 3 years, but they're saying after 5 years, it's 5 out of 5. So if you hold on to this ETF long enough, it should generate a nice return for you. It has an annual dividend yield of 1.94% that's distributed quarterly. But what we're most interested in here is the holdings of this here ETF. Now, as I said, all of these are going to be Dividend Aristocrats. That's what this ETF holds. And right here is the largest weighting of the assets that are in this ETF, the largest being WW Grainger, then Nucor, Chevron, Archer Daniels Midland, Exxon, Caterpillar, Albemarle, Automatic Data Processing, West Pharmaceuticals, and Franklin Resources. There are 64 total holdings in this ETF. Now, if you look at up here, it's going to say how many shares it is, the market value. But what we're interested in here is the 6-month return, 1-year return, and year-to-date. Not so much year-to-date because the year just started, but basically the 1-year return and the 6-month return. So let's go ahead and organize this by the 1-year returns. And again, I think these are the ones that, for the most part, are going to work for the year coming up. Maybe not some of the food companies, but most of these will actually work. So Nucor had a 65% 1-year return. It's been up 28% over the last 6 months, and actually it's been up pretty good this year. Exxon's been up 57%. Cardinal Health, let's call that 50%. Chevron's 42.5%. And then there's a little bit of a fall off here. We go down to Genuine Parts Company at 23.8%. Archer Daniels Midland, 22.9%. They're the food company I was alluding to. They had a good year last year, but you can see they're down 8.72% this year because, food inflation is just coming down right now. Albemarle is at 16.8%, Aflac is at 16.74%, Caterpillar is at 16.64%, and Chubb is at 14.8%. A lot of these ended up being their largest holdings anyway, but there were some that snuck in here, such as Aflac and Chubb. So we're going to have a look at the ones that are going to give us the biggest return, and after we look at that, we're going to compare what the total return is from owning some of these holdings, be it from their 1-year gains and from their dividend returns and from their option premiums. All right, so I came up with this presentation, and a good starting point was the top returning stocks from that Dividend Aristocrat ETF. And the top returning stocks were going to be Nucor, Exxon, Cardinal Health, Chevron, Genuine Parts Company, Archer Daniels Midland, Albemarle, Aflac, Caterpillar, Chubb, Cintas, and W.W. Grainger. Now, from these stocks, I decided, well, let's go ahead and see what kind of dividends each one of these top underlying equity gainers are producing. Because remember, we're talking about the underlying equity appreciation plus dividends plus option premiums to try and give us a total return that's going to try and outpace this market at this time. Now, when we look at the dividends, Nucor was paying 1.33% annual dividend, or $2.04 a share annually. Exxon was at 3.21%, Cardinal Health 2.62%, on down the list where we get down here to the ProShares Dividend Aristocrat ETF, because I thought, what if I just want to own the entire ETF, but not necessarily any holdings in particular? Because what if this year is different from last year, but I still think that these are going to be good. Maybe I just want the whole ETF. And that was giving a 1.94% annual dividend return. Now, from this list, I decided, okay, let me just pick out my favorites from this list. And now everything on this list is good, obviously, but from this list, what were my personal favorites? What were the ones I was going to consider? And from this list, I decided to go with Exxon, Cardinal Health, Chevron, Genuine Parts Company, Aflac, Nucor, and the actual ETF. And I know that Nucor had a very small dividend. However, you can't ignore the underlying equity growth of 65%. It simply has to be in my list. So Nucor is in this list. And then the next thing we look at, now that we have the growth and the dividend, let's go ahead and look at the options premiums. Now, when I calculate these options premiums, these were all for a February expiration. And let me show you how I did this. So let's take the example of Nucor. So Nucor right now is trading for $153.47 a share. If we decide that we're going to, let's say, buy 100 shares of Nucor and then sell a covered call contract on this, then we would look for the expiration date of February 17th. Some equities have weekly options expirations like Nucor here, and some like Genuine Parts Company are only going to trade monthly options. So when we look at this thing, it only trades monthly options, and so this options expire on February 17th, and there are a lot of companies that will expire on February 17th. That's why yesterday was such a big options day, because January 20th was the options expiration date for January. In February, the options expiration date for February is going to be February 17th. Again, let's go ahead and look at Nucor again. And we'll look at the options premiums that expire on February 17th. So we'll go ahead and we'll click February 17th. And what we're saying is that if Nucor is, now this is an in-the-money option, if Nucor is above $150 on the 17th of February, I will sell you 100 shares of Nucor for $150. To take this bet, someone's going to give me $8.57 a share, or $857 right here. That brings my break even on Nucor to $158.57, meaning I've already collected $8.57. So should Nucor go up to $170, I still have to sell everything for $150, but I'm guaranteed the $150 plus the $8.57. If Nucor should fall below $150 by the 17th of February, say it's sitting at $145, I will keep all of my Nucor shares, plus I'll get to keep their $857. And that's the option premium. And I'll demonstrate that what I did over this past week, because I sold I did what's called selling puts this week. It's a similar concept, but kind of a little bit different, but we'll get that in a second. So when I was looking at these option premiums, granted the Nucor one was well in the money, but I'm just kind of estimating it's roughly about a 5% options premiums you get on Nucor. And then I had to look and see, hey, was Nucor going to, because that's a lot of money there, for an option for a dividend aristocrat, because they're not particularly volatile stocks. I was like, why is that one paying so much? Is it because they're going to report earnings that day? No, they report earnings, I think, this week or next week. So they're reporting earnings really, really soon. It's just that they pay a lot of money for their options premium. So that's got a high year-on-year return, plus it pays a big options premium, and it has a small dividend of only 1.33%. Others on this list I liked was Exxon. Then I also like Cardinal Health, Chevron, and Genuine Parts Company, and Aflac. The NOBL ETF paid a 2% when I did that same thing when I showed you with covered call. NOBL does about a 2% return on their monthly options. Cardinal Health paid a really big one, and I was kind of wondering, why is Cardinal Health premium so good? Well, the reason why is this. When you look at Cardinal Health, it's a decent company. I think it looks like they distribute pharmaceutical products. They distribute pills, I guess. And so they're in the pharmaceutical industry. And when you look at this company, again, they've got that 49.22% 1-year return. Over 3 years, they're up 37%. So it's not been a great performer like long term, but over this past year, it's been really good. But the problem with Cardinal Health is that when you look at its price to earnings ratio, the company is not profitable at the moment. It's got a forward PE of 14.27%. They believe it will be profitable in the year to come, but right now it's not profitable at all. So this might explain why the underlying equity is going up in a straight line the way it is, because people are trying to get ahead of this 14.27% price to earnings ratio. When you look down here, its earnings growth forecast is 10%, but its profit margin is a negative number. And because it's not a profitable company, the company is going to actually trade a little bit of a higher premium on its option, because it's looked at as being more of a volatile company. And you may say to yourself, well, how come that company is able to be unprofitable and people love it, and it's a dividend aristocrat, and you never turn on your TV and people talk about how expensive Cardinal Health is? Yeah, I get it. I don't like the rules either, and I don't understand the rules, but I just play by the rules. Because if you look at something like Eli Lilly here, Lilly's trading for $346 a share. It's got a 1-year return of 43.94%. It's been said to have the prettiest chart in the business. Over the past 3 years, it's up 144%. However, Eli Lilly trades with a price to earnings ratio of 52, a forward PE of 44. And people just look at this. You'll never hear people saying, hey, Eli Lilly is really expensive. How come Eli Lilly's not laying a bunch of people off? No, instead the company they're going to complain about is going to be Apple here. This is the one you'll turn on the TV and say, how come Apple's not laying people off? How come Apple's trading so expensive? The entire tech complex needs to come down 50%. Well, Apple's trading at a price to earnings ratio of 22 with a forward PE also of 22. It's basically half as expensive as Eli Lilly, but you're not going to hear anybody up in arms about how expensive Eli Lilly is, because Eli Lilly is part of the recessionary playbook, because it's a healthcare company, and Apple is on the outs because it's a tech company. And I don't make the rules. I don't like the rules. I don't understand the rules. All I'm trying to do is play by the rules. And right now, the healthcare companies are the ones to own, but the tech companies are not. Even though these are a far better deal, I would say as soon as the Fed pivots, we want to pile this thing into these types of companies like a fat kid at a taco bar. But right now for me anyway, personally, I'm kind of staying away from these, with the exception of like selling puts on some of these underlying equities. So let's look at some of the stocks from the Dividend Aristocrat ETF that I'm looking at, like trading and wouldn't mind owning at this time. And right now, the ones that I like the best are going to be Exxon, Chevron, Nucor, and Cardinal Health. And these are the ones that I think for myself are going to generate the best overall return from the underlying equity, the dividend returns, and the option premiums I'm going to get from holding on to these equities. Just in case you're curious, I actually put in the NOBL. One would show that it's about 2% options, 1.94% dividends. It doesn't give you an overall great return. I could make it work. I could actually make money on this one because through options. But it's not one of my bigger choices here. If I'm gonna go into this, I'm gonna get a little bit more risky and own some of the individual holdings. JEPI, as you know, if you follow this channel, I own a lot of this. Its 1-year return is negative 8.71%. It pays a dividend of 11.68%. So over the year, it's up about 3%, and I'm getting about 1% on the options that I own on the underlyings. So let's go ahead and take a look at my options from last week. So if you look at my options trades from last week, from the 16th of January through the 21st of January, I was kind of active last week. It's not as active as it looks. Sometimes you sell to open, sometimes you buy to close. It's still all one options trade. I did swing trade ExxonMobil for a little bit of a gain. All told, I took in about $802.61 last week. Some of this is not quite realized yet. I do have some sold puts that are open. It looks like about maybe $300 worth right here of open puts, and we'll talk about what that means in just a second. So I've currently got 3 options open. They're going to be on Exxon, Microsoft, and Chevron. Right now on these ones, I've sold puts on these, and I'm going to talk about what it means to sell a put and why I actually chose these equities to sell puts on this week. Now, selling a put works a little bit like this. So let's talk about Microsoft here. I just picked this underlying equity. I went ahead and I sold a put. It's got an expiration date of the 27th of January, which is next Friday. My strike price was $222.50. I sold it to open. It looks like they're paying 89 cents per share, or $89 per contract. What this means is that if Microsoft finishes below $222.50 by the 27th of January, I would be on the hook to buy 100 shares of Microsoft for $222.50 per share. So if it finishes at 220, I still have to pay 222.50. That's why I'm doing this contract here. If someone has sold me this contract. However, if Microsoft finishes at 230, then I don't have to buy any Microsoft and I get to keep their money. And what makes this pretty interesting is because I feel like in a way I'm getting a loan, but it's a loan that I don't pay interest on. So I'm basically just taking this small bet, and really it is kind of small. This $89, if it collapses to like 218, I just try and buy my way out of it. I'm like, okay, well, I lost that one. Now you may say, why is it that Microsoft would even pay you anything for finishing $18 down by next Friday? Well, this all comes down to volatility, and Microsoft is volatile right now because this Tuesday, they're reporting earnings. And because Microsoft is reporting earnings on Tuesday, you get a pretty nice premium for selling puts on Microsoft because it's really volatile. Because right now, if you look at this right here, there's no value in this contract from the perspective of the underlying asset, because right now it's selling for 240 and the contract's saying at 222.50. So all of this money is coming from time and volatility, and since there's not much time left, this is all coming from volatility. So you're getting all this money, selling it way out of the money because it's about to report earnings on Tuesday. And I did the same thing over here with Chevron, which reports earnings on Friday. So when you look at my open options this week, I have 3 puts that are open, all on companies that I don't mind owning. One on Exxon, one on Microsoft, one on Chevron. Now, do I plan on collecting all $320 from these contracts? Absolutely not. It's not the way I do this, and it's not the way anyone should do this. When you get up on these contracts, go ahead and take the money. I'm not going to wait for Chevron to pay me $126. I'm going to, in all likelihood, hopefully take about $100, buy my way out of it for $26, and I'll get to pocket $100. It's the reason why I wasn't going to go into this, but it's the reason why I was able to make like $87 on Goldman Sachs this past week. They bombed on earnings. They collapsed yesterday after the Fed opened up some sort of investigation on them. And yet I still made $87. Why? Because when I got up, I took the money. If I had waited, I would have lost money. Same with Schlumberger. I made $41 on them yesterday. However, if I had waited till the end of the day, I would have lost some money on them. So when you get up, take the money, take your small gains. All right, well, that's going to do it for this week. So it looks like I'm going to be adding a couple of new positions to my portfolio, at least sell puts on them on Cardinal Health and Nucor. If you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye. And now a word from my sponsor. I'm beginning to feel a little bit like Batman. Only instead of finding justice, I find money, even in a recession. So wherever you go and whatever you do, I will be there, money. And whatever applies to money goes double for you, beer. And this beer is Dogfish Head 60-minute IPA. And I unapologetically give this 5 Kate Rooneys out of 5. Have a great week, everyone.